The importance of a stop-loss in the stock market is akin to the significance of a safety helmet in a game of cricket. Picture a stop-loss as a predetermined price level at which an investor decides to offload a stock to limit their losses. Here's why stop-losses are so critical. First, they are a key tool for risk management. They allow investors to set a maximum loss they're willing to endure on a trade, shielding them from potentially ruinous losses in unpredictable markets. Second, they help manage emotional control. Emotions can spur impulsive decisions. Stop losses serve as a logical, predefined exit strategy, dampening the sway of fear and greed on trading decisions. Third, they aid in protecting capital. Keeping your capital intact is crucial for long-term success. Stop losses safeguard your investment capital, ensuring you have funds left for future opportunities. Fourth, they help avoid large losses. Without a stop loss, you might cling to a plummeting stock hoping it will bounce back. This can lead to hefty losses. A stop loss prevents such scenarios. Fifth, they instill discipline. Employing stop losses instates discipline in your trading strategy, helping you adhere to your predetermined risk tolerance and trading plan. Finally, they offer peace of mind. Knowing you have a safety net in the form of a stop loss can alleviate anxiety and stress linked to stock market investments. In a nutshell, stop losses are an invaluable tool for risk management and maintaining discipline in the stock market. They safeguard your capital and ensure a structured approach to trading, boosting your chances of long-term success.